do it the other way. Before is like this. Again, we take the 100,000 out of the cash, so the total assets are 900, and so that's the value to the shareholders as well, 900. But this time we've bought back the stock, so there's only 90,000 shares at a tenner each this time. So the difference is you're getting a difference in the number of shares and the number of shareholders. But the two effects, whether you do it by cash or do it by stock split, is the same. That's the fundamental. And so if you're going to change that either by cash or by giving stocks or by buying back stocks, and both of those have the same effect on the firm, there's no difference between them. And so yet again, the MM guys clarify the set of conditions under which dividend policy is irrelevant to the firm. They're the conditions. They're the same as capital structure, Modigliani Miller. And so the conditions, these assumptions are sufficient to guarantee that the dividend decision does not impact on firm value. It's not impacting on capital budgeting. It's not impacting on any other real decision of the firm. So the question then is whether paying dividends and financing them by issuing stock changes firm value. So paying dividends is cash out. So if you make a cash out payment, okay, and you pay for it by issuing stock, or you pay for it by, sorry, what have I done? Okay, so if you pay dividends, and you finance the dividends by diluting the stock, should it affect firm value? And the answer is, under the Modigliani-Miller conditions, those kinds of magical shifting of the capital structure or dividend policy will not change anything significant in the firm and will have no effect on the firm value. So in order to generate an effect of dividends policy, there must be some capital market imperfection that will make dividend policy significant. They have shown that purely swapping dividends for cash or dividends for stock splits does not affect the fundamental value of the firm, unless it's going to affect some of these real factors. And that's again is the insight of Modigliani-Miller irrelevance. If you've got no taxes and perfect information and perfect capital markets, etc., the private investors can always mimic the capital structure of the firm. And so dividend policy is only part of the capital structure of the firm. Will I give a stock split? Will I give a dividend? Will I give out cash? Will I give out stocks? It's just substituting one for the other in a way that the individual investor can always substitute himself or herself without needing the firm to do it. So once you understand that logic and that way of seeing it, the only way capital structure or dividend policy can affect firm value is by affecting the attractiveness of investing in the firm to the shareholder. And how can it do that? Only by the conduits, which are the assumptions that give you Modigliani-Miller irrelevance when they hold. Right? Stock dividend.
When you pay that out, the share price goes down, so overall the equity amount will remain the same. Is that the
No, the stock dividend.
sorry, just looking at the two examples you have throughout.
Yeah.
I was just wondering what's the actual effect?
No effect on the value of the share. I'm just showing what's happening is that
If you
when
got more, would the price not reflect the fact that you've put more shares into the market?
no, that won't affect, because that's the point, that it will not affect, because the individual can decide whether to do that himself or herself without the firm doing it for them. If, for example,
so John, maybe John is, it's the market value doesn't change. That's the point. There's more shares in issue with a lower price, not the price of the stock split.
What's the effect on the balance sheet?
There's no change on the value of the firm.
What's the effect on the balance sheet?
No.
Bit of a sleeper.
I'm not good enough to an accountant to be able to talk on the balance sheet.
Okay.
It's pure stock split is what you're talking about. So there's no cash outlay. Yeah.
I think he's asking, when you pay dividends, the value of your company goes down because your company now has less stuff. Now you've given away the stuff. Is that what you're asking?
Yeah, but does not accounting entry reflect the dividend being paid out in shares?
It's like
There's more
tennis.
shares in issue, yes.
So there are two sides to the entry?
That's a good question, actually.
It is a good question. I don't know.
I think it's assuming that the par value and the market value of the shares are exactly the same amount.
It is, and so what I'm saying is those assumptions are that the price of the share on the market is not changing. Whatever you're doing to the accounts, the balance sheet has gone down by 100,000, but the value of the stock traded in the stock market has not changed. And so whether you pay it at all or you
But
don't
it doesn't
pay
change because, well, it doesn't change. It does. The value doesn't change because the price would the price not reflect that there's more shares, so the total to the shareholder will remain the same. Do you know? Yeah. Do you know what I'm saying?
a higher earnings per share is compensated by lower number of shares. Or a lower earnings per share is compensated by the fact that there are more shares outstanding, as you give a stock split.
Okay.
But the stock market valuation of the shares will not be influenced by that, because investors will not see there's any value in it for them in a Modigliani Miller world.
So it's a 50-50 stock, they just have twice the amount of half value shares. So
Exactly, and if they don't want twice as many, then they're just going to sell them and convert them into cash.
Yeah.
Isn't it like when a firm announces that it's going to pay out dividends, that's like on the market everybody's buying it prior to the...
Well, he said that doesn't
Yes,
mention
yeah. And this, now we're now coming to this, I want to get to this, we're now coming, why does that happen? Because in a Modigliani Miller world it should not happen. Because everybody would be so super rational, and they would know that there is no value effect on the firm, and it doesn't matter, and so there would be no pre dividend run up. And so the fact that there is tells you the world is not Modigliani Miller. That's the way to argue that.
But you remember when the government did the Eircom sell-off, and they had this bonus share if you hung in for a year? Does this basically mean that they ripped us off? Because most people were inexperienced at stock trading who got into that because they all thought they'd make a fast buck, and they could have. But a lot of people hung in for the year because they thought that the fair share was actually worth something. But this is basically saying it isn't, right?
Yeah.
And they would have known this.
Well, it's saying that it isn't in a Modigliani Miller world. But this government, I can assure you, does not live in a Modigliani Miller. They control the tax rates for starters,
Yeah.
and so they know. But they aren't trying. I cannot conceive of how that could have been of any value to anybody, even in a non-Modigliani Miller. But it does. The average punter goes, "Oh, there is an effect. I should hang on for this."
Yeah.
That a finance econometrician would prove to you that even if there is a temporary effect, blip effect, it'll wash out after a few months.
So they ripped us off.
Well, I mean, in many ways, you want me to say it.
They charged us like they sold the Brooklyn Bridge to us.
The signalling effect though is to a sort of investor who kind of goes, I would want the kind of cash in the hand type thing. They want to continue a stream of income, but that's not rational. But in reality, it would affect the company's market share if you give dividend.
Now you've nailed it. That is where we're trying to get at in this course, to get you to be able to articulate corporate financial policy in precisely those terms. Okay, we've nailed it. So remember what you said.
SWAT.
What did you say?
Yeah, he's going to the match fairly soon. Yeah, well, I mean, effectively what he said is the reason why signalling is important. It's because it's corporate financial managers, if they want to give a consistent dividend, they want to signal to the market that they are able to give a consistent dividend. And why do they feel that they need to signal to the market? Because they know that the market knows that they have superior information. They know that there's information asymmetry. And so they're saying to the market, we know the world's not Modigliani Miller, and so there are information asymmetries, and we want to help you. We want to give you comfort that we're not trying to rip you off. Right? And so the best way we can give a hard signal to you is give you a hard cash dividend, not mucking around with stock splits or whatever. We give you a hard dividend consistently and of the same intervals and same amount consistently over time. Got it? It's precisely because they understand that dividend policy can matter, can influence fair value in the real world, where there are all sorts of uncertainties and information asymmetries and stakeholder perceptions about whether the firm's managers are looking after their own interests or the interests of shareholders or what they're doing. That dividend policy is seen as a discipline whereby they are signalling to the market, guys, we know it's not world, and here's our way of giving a hard signal to say, believe us. We are credible, we are consistent, we have a track record, we deliver when we say we will.
This is a more general question, but in general, do Irish companies pay dividends or not?
I don't know is the answer.
You don't? Okay. There isn't a countrywide trend from country to country. So I think like we have a low corporate tax rate, yet a high.
Yeah, it's not an area that I specialise in, so I don't know.
Typically they would have, yeah.
They would.
Typically they would.
Typically they would.
Whereas Ryanair doesn't.
They don't.
They did recently.
They did recently.
Yeah, but they loads of cash, didn't they?
Yeah, but they did recently. But they made it very clear in the statements that they ain't going to do it again, or don't get hooked on it. And so you actually wonder, why did they bother? I would say everything I know about dividend policy, they probably shouldn't have done that.
Is that because they see themselves just growing much bigger than what they are now? Obviously, I mean, that's the only reason.
Exactly. And so if they see, to me, the dividend policy, then that is going to go against, because if they're not giving dividends and suddenly they start give one or two, I think they're signalling to the market something that they should not be signalling to the market, and that is that we think we have now come to a maturity in our growth and we don't see prospects for more growth.
That's what O'Leary said when he paid it out. Was that what you just said?
Okay, so maybe
He said he bought a brand new fleet of aircraft and he had nothing to spend the money on, and the markets were in contraction because of the recession. So
fair enough. So
that was. So I'm just saying that's what his logic was.
Okay.